So you bought your insurance policy to protect something specific, probably a mortgage, kids who depend on your income, and a spouse who'd be on their own if something were to happen to you. That made complete sense at the time. But here's a question that most people don't stop and ask. Is that policy still solving the same problem? Or has your life changed enough that the coverage that you're currently paying every month doesn't currently fit your life anymore? In this video, I'm going to walk you through a 5-question insurance audit that Canadians in their 40s and 50s should be doing right now. Hey, quick intro before we get into it. I'm Zach from Odyssey Wealth. I'm a certified financial planner and I hold a license in life and health insurance. And I'm registered for investment advice through Design Securities, which is a zero regulated dealer. This video is for education purposes only, not personalized financial advice. Everyone's situation is different, so use this as a starting point and not a plan. Now, there are 2 ways that insurance can go wrong at this stage of life. Both are expensive, both are invisible until they're not. Think about what was true when you bought your policy. The mortgage was big, the kids were young, your spouse needed your income to survive. Now, the mortgage might be gone, the kids are grown up and out of the house. You and your spouse have savings built up. The problem that the policy was designed to solve has mostly taken care of itself, but the premium is still coming out of your account every month. On the other side, your life may have created risks that your original policy was not designed to cover. Your estate is bigger, maybe you have a dependent that needs long-term support, maybe your pension ends when you do, and your spouse's financial security goes with it. Both failures look the same from the outside. You have insurance, you're paying the premium, everything must be fine. The assumption is the problem. Now, there are 4 types of insurance coverages worth reviewing: life insurance, disability insurance, critical illness insurance, long-term care. Most people think of insurance as one thing. It's actually 4 different categories, and each answers a different question. The first and most common one is term life insurance, a policy that pays a lump sum to your beneficiaries if you die within the coverage period. Premiums are typically level for the term, and coverage ends when the term expires. Term insurance is great for income replacement, especially if you have young kids, or for something like a fixed term like a mortgage that you would need to get paid off in the event that you weren't able to work and pay it off anymore. Next up would be disability insurance. Disability insurance is coverage that protects a portion of your income if you're not able to work due to illness or injury. Now, it only covers up to a certain percentage. Group policies through insurers usually cover up to a maximum of 60 to 70% of your income, up to a cap. So the big question is, if I can't work, can I still pay my bills? This is a chronically underestimated question. You're far more likely to be disabled than die during your working years. Next is critical illness or CI insurance. Critical illness provides a lump sum if you're diagnosed with something serious, like cancer, a heart attack, or a stroke. The idea and the hope is that you survive it, but surviving comes with a cost often that our healthcare system can't cover. And last would be long-term care. If I need ongoing personal care, either at home or in a facility, who pays for that? Now, I'm going to focus on life and disability today because those are the 2 that often need the most updating at this stage of life. And as full disclosure, I hold an LLQP license, which means that I'm qualified to advise on all 4. Life insurance was designed to replace your income if you weren't there to earn it. So the question is today, how much money does your family actually need to replace? Here's a quick exercise. If I were to die today, what does my spouse's financial picture actually look like? So let's do this. Add up their income, any CPP survivor benefit, any pension survivor payment, and all the assets that they'd have access to. Add that up. Is there a gap that creates real financial hardship? If yes, that's what the insurance needs to cover. If no, you may be overinsured. There's also the estate angle. If you don't have a surviving spouse to pass your RSP to, your registered savings become fully taxable when you pass. On a $500,000 balance, you could be looking at $200,000 or more going straight to the CRA. Some people use life insurance specifically to cover that tax bill. 1 in 3 Canadians will experience a disability lasting 90 days or longer during their working years. Most have some group coverage through their employer. Most have no idea what that coverage actually pays. Employer group policies typically replace 60 to 70% of your income up to a fixed benefit maximum. If your salary has grown significantly since the plan was first set up, the gap may cover significantly less than the coverage suggests. Group plans typically cover 60 to 70% of your income up to a cap. If your income has grown, that cap may not cover what you actually need anymore. And here's the part that surprises most people. Most employer group plans end when your employment ends. Change jobs, go self-employed, retire early. Your coverage could be completely gone right at the point in time when individual coverage is the hardest and most expensive that you can get. Let me walk you through an example of something that I see pretty regularly. I'll call her Margaret. Now, Margaret is 57, widowed, and works in the public sector. She has a defined benefit pension that will pay her $62,000 a year when she retires at 60. Her home is paid off. She has a grown daughter and an RSP that she's been contributing to faithfully for a number of years. Margaret has held the same life insurance policy since she was 38, $800,000 in coverage. The original purpose was straightforward: to protect her income and to pay off her mortgage if something were to happen to her. At 38, that made complete sense. At 57, the mortgage was gone. Her daughter was financially independent, and that pension, it stops when Margaret does. But the good thing is her daughter doesn't depend on it. So Margaret was paying $280 a month on premiums for an issue that stopped being an issue about 20 years ago. With 3 years left on the term, that's roughly $10,000 in insurance premiums, heading toward a benefit that serves nobody in her life right now. But here's what the review also found. Margaret's RSP had grown to $340,000, and she has no surviving spouse to roll over to tax-free when she dies. Under current rules, that means that her RSP becomes fully taxable in the year that she dies. Now, her daughter's going to get something. She's going to get what's left after the CRA takes its share at Margaret's highest marginal tax rate. That projected tax bill, once we factored everything in, was going to be around $112,000. So here's what we did. We canceled the existing term policy. We took that same monthly premium and a small top-up and redirected it into a permanent whole life policy. We sized it specifically to try to target that projected tax bill. Same monthly budget, different allocation. The result? Margaret's daughter receives the RSP amount after tax, just like before, and she receives the additional tax-free insurance benefit on top of it. No additional out-of-pocket costs to Margaret. Margaret's original policy had been protecting her family for 19 years. By 57, it was faithfully paying for protection that nobody needed anymore. Now, the review didn't just correct that. It turned the same budget into something that would genuinely benefit her daughter in ways the original policy couldn't have. A 20-minute review changed where the money was going and actually covered what mattered. So 5 questions. Answer them honestly. They'll tell you whether your coverage still fits. Question 1. What risk is my current policy actually solving? Income replacement, mortgage coverage. Is that risk still there at the same scale it was when I bought the policy? Question 2. If I die tomorrow, what income does my spouse actually have and for how long? Do they have a CPP survivor benefit, a pension survivor benefit, their own savings? Is there a real gap? Question 3. What happens to my registered savings when I die if there's no surviving spouse? Do you know the tax exposure? Number 4, does my disability coverage actually match my current income? When did you last check the benefit cap? And number 5, when did I last have this reviewed by someone with an obligation to my full financial plan and not just the policy they sold to me? Insurance reviewed on its own is at best guesswork. Reviewed as part of your full financial plan, alongside your pension, your RSP, your estate. It's protection that actually works for your life as it is now. Now, if the last time that you looked at your insurance coverage was the day that you got the policy, that review is overdue. At Odyssey Wealth, a complimentary consultation takes a look at your full financial picture. Insurance, pension, RSP, your estate, everything together. We're not selling you a policy. We're telling you whether what you have still makes sense for your life. A link to book is in the description. Please subscribe. There's a new video every week. We help Canadians as they move into retirement answer the questions that they've always had and oftentimes have been scared to ask. Again, my name is Zach. Peace, much love, God bless.